The latest snapshot of the U.S. economy was released by the Labor Department earlier today.
The U.S. Consumer Price Index report showing a smaller than expected increase in consumer prices for the month of August. Our 18 News reporter Ria Jha took a deeper dive into why economists were bracing for a hotter inflation report and what this lower increase means.
The Labor Department reported today that U.S. consumer prices rose by 0.3% in August, the smallest increase in 7 months. Economists were bracing for a much higher increase, but the report showed the August gain was weaker than the 0.5% increase in July and a 0.9% surge in June.
The expectation was that we were going to continue to see prices increase, driven by the labor market, driven by the supply chain problems.
Now economists are hoping this is a sign that the recent jump in inflation may be cooling.
We had a summer of inflation. That rate has slowed, but we still don't know exactly how across the whole gamut of areas that interact with people's lives, their food, their transportation, their lodging, their healthcare costs, etc., how that's going to impact.
Federal Reserve officials have been saying that the inflation the country is currently seeing is transitory.
Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary.
But experts are still predicting a drop in consumer sentiment in their next report.
Willingness to spend appears likely will be lower than it was at the beginning of the summer, in part because of increasing prices, increasing inflation.
Reporting in Elmira, Ria Jha, 18 News.